back to our channel, RR Corporates. We have other channel, RR Legal Talks. So in this video, we are talking about SME IPO. So we are doing a review of SME IPO 3B Films Limited. 3B Films Limited. Should you invest? So there is another SME IPO here. That is 3B Films Limited. Is making headline with a sharp jump in profits and ambitious expansion plans. Is it worthy to your money, or is it a pricey gamble? Let's break it all down: financials, valuations, risk, and strategy. So we'll see the company overview. About 3B Films Limited, this is incorporated to manufacture and market CPP and CPE films. 3B Films is targeting the flexible packing and thermoforming industries. It offers a range of high quality cast polypropylene and polyethylene films used across food, beverage, clothing, flowers, and more. In the year 2024, the company expanded into trading adhesive laminated films and even booked a turnover of 22.59 crore in its first year of trading. So to move beyond trading, now it plans to start manufacturing these laminated films to capitalize on future market demand. It also processes manufacturing scrap into granules. So a great example of circular economy practices and additional income. So now we'll go to IPO details. We'll move on to full details of this issue. So this IPO already opened 30th May 2025 and closing on 3rd June 2025. So issue price 50 rupees per share. This is a fixed price. Issue price is here, fixed price, that is 50 rupees price. Closing date IPO is 3rd June 2025 because in between Saturday, Sunday came. So it opened on 30th May. And issue price 50 rupees and size 33.75 crore. So total number of shares, issue size is 67.5 lakh shares aggregating to 33.75 crore. This is the issue size. Out of this 33.75 crore, there is a fresh issue and a portion of offer for sale, that is OFS. So fresh issue portion is 17.76. So 17.76 crore out of 33.75, the issue size, 17.76 is a fresh issue, and remaining 15.99 is the offer for sale, that is OFS. So the post-IPO market cap is 123.86 crore. This is the post-IPO market cap. So it is going to be listed on BSE SME. Listing exchange is a BSE SME. Lot size 3,000 shares. This is the lot size. Price 50 rupees per share. See, the retail quota is 50%. There is no quota for QIBs. HNI is 50%. So retail quota 50%, HNI 50%, total 100%. Lot size 300 shares. So the allotment, the allotment of 3B Films IPO date is June 4th, 2025. Because the issue closes on June 3rd and the allotment date is June 4th, 2025. Now we'll discuss about the use of funds allocation. This is the most important. See, for CapEx, they have allocated 4.43 crores for CapEx. And working capital 7.15 crore for working capital. And general corporate purposes, that is GCP, 4.44 crores. And IPO expenses 1.74 crore. This is the fund allocation. Now, what about financial performance of the company? If we go into the revenues and profit, see, if you see the financial year revenues and profit, we'll come back to financial year 22. In the year 2022, the revenue was 68.07 crore, but profit was in minus 0.35 crore. In 2023, the revenue was 72.82 crores and the profits were 0.92 crore, so 92 lakh. In the year financial year 2024, the revenue was 76.4 crore, 76 crore 40 lakh. Then profit was 4.29. For 9 months financial year 2025, the revenue 57.18 crore and the net profits 4.2 crore. So if we see the key ratios, EPS, earning per share average 1.13, and RoNW, return on net worth, average 7.87. I will explain how RoNW will calculate. After this presentation, this public issue details, then I will explain RoNW, how it will calculate. And also debt equity ratio, see December 2024, 2.89. We can say it is a little high. 2.89 debt equity ratio is high. PAT margin, financial year 2024, 5.67%. And RoCE, 8.64. I'll give you the calculation also. Then if you see valuation multiples, financial year 24, P by E 28.9. And even financial year 25, annualized P by yield 22.12. So post-IPO, P by E, book value, P by BV is equal to 2.34. So what is this observation? The sharp rise in profits from 2024 onwards is attributed mainly to higher margin trading activities. Whether this growth is sustainable, so this may uncertain also. So we will see the strength of the company, and we'll also discuss on concerns. Now we'll talk about the positives and strength of this company. Yes, the company has a diverse revenue stream. Manufacturing is there, trading is there, byproduct reprocessing is there. These are all the qualities, positive qualities. And the entry into higher margin adhesive laminated films. This is also another positive strength. And contribution to circular economy, strong expansion focus. So now here the concerns. What about the concerns? You see the concerns. Aggressively priced IPO. This is the concern. And very high debt equity ratio. This is also another concern. And sudden jump into profitability arises sustainability question. And no dividend history in this company. Only one past IPO by merchant banker, which listed at a discount. So the peer comparison and the market trends, if we observe, there is no direct listed peers for an apple to apple comparison. So past SME IPO has shown volatile listing performance with operator influence and limited liquidity being key risk. This is the past SME IPO. And then conclusion, should you invest this? You want, this is a conclusion. So based on the financial year 24 and 25 numbers, the IPO is aggressively priced and well-informed investors. Well-informed investors may consider parking moderate funds in this pricey bet, keeping in mind the risk involved. And our take, if you are an investor with a high risk appetite, yes, this could be a calculated entry into packing material space. If you are conservative or new IPO investor, new SME IPOs, so you might want to stay cautious or allocate a small portion of your funds. Then like this video if you found it useful. Subscribe for more SME IPOs, reviews and financial deep dives. Share with friends considering SME investments. So in between video, I told you I'll explain about RoCE and RoNW. For beginners, even for students, this RoCE is a return on capital employed. Why we'll discuss on IPOs, I'll explain. So this RoCE is a financial ratio that measures a company's profitability and the efficiency with which it uses its capital. So it is particularly useful for evaluating business that require large investments in assets like manufacturing companies. See, the formula involved in this RoCE is equal to earning before interest and tax, EBIT, divided by capital employed into 100. So EBIT, earning before interest and tax, capital employed, how it comes, total assets minus current liabilities. Otherwise, take as equity plus non-current debt. So what it tells is a higher RoCE, higher return on capital employed means the company is using its capital more efficiently to generate profits. So it helps investor to understand how well a company is using its long-term capital to generate returns. So I'll give you an example. If a company has EBIT 10 crore, earning before interest and tax is 10 crore. Capital employed is 100 crore. So then RoCE is equal to return on capital employed is equal to 10 divided by 100. EBIT divided by capital employed into 100. So 10%. So this means the company earns 10 rupee for every 100 rupee it employs at a 10% return. Hope we are clear on RoCE. So why RoCE is important for especially for IPOs? It shows how efficiently a company uses investor and lender money. It is a better indicator than just a net profit margin for capital heavy business. Investors compare RoCE across companies and the industries to assess investment quality. And we'll come back to RoNW, return on net worth. So it is a financial ratio that measures how effectively a company generates profit from its net worth. Here we are talking about shareholders' equity. It is also referred to return on equity, ROE. Here the formula is return on net worth is equal to, here we are talking net profit after tax divided by net worth into 100. So how will this net profit is a profit after tax at net worth is equal to share capital plus reserves and surplus, that is shareholders' equity, reserves and surplus. So return on net worth shows how much return the company is giving to its equity shareholders. A higher RoNW, return on net worth, indicates better efficiency generating profits from the equity capital. I'll give you an example. So for better understanding, so net worth is, suppose one company has net profit of 5 crore, net worth is 50 crore. So then RoNW is equal to net profit divided by net worth. That is 5 divided by 50 into 100. That is equal to 10%. So this means the company is generating a 10% of return on money invested by its shareholders. So this is useful for comparing profitability across companies in the same industry. RoNW matters. A rising RoNW indicates improving financial health. So for IPO investors, It helps assess whether the company is delivering value to its owners. As an investor, you should check RoNW, RoCE. So here, the disclaimer from my end, the content presented by me in this video is for educational and informational purpose only. Should not be construed as financial or investment advice. The views expressed based on the publicly available information and personal my analysis, and do not constitute a recommendation to buy or hold any securities or any financial instruments. So you are strongly advised to consult a certified financial advisor or own investment consultant before making any investment decisions. So investment is securities. Investment in securities is subject to market risk, and past performance is not indicative for future returns. You know very well. So we do not accept any liability for any loss or damage arising either directly or indirectly from the use of this video or its content. So this channel or the speaker are not responsible for any actions taken based on the information provided by hearing from. So this is only for information. Thank you. Thank you very much. Thank you. Thanks for watching this video.